When a complex financial model collapses, the failure rarely starts with a massive error. It begins with a single microscopic fracture, a dropped cell or a misplaced sign that triggers a catastrophic structural failure across thousands of linked calculations. Building a financial forecast is an exercise in absolute mathematical tension. A model is completely invalid unless the balance sheet strictly balances to zero. Any deviation means the entire projection is built on a mathematical fiction. Imbalances persist because analysts often treat the income statement, balance sheet, and cash flow statement as isolated tables. In reality, they form a strict, closed-loop mathematical system. Securing that system requires mapping the hard operational linkages between these three statements, ensuring every dollar of revenue, expense, and capital flows perfectly from one document to the next. Once the base operations are wired, the model must accommodate the debt schedule, a highly volatile engine programmed to dynamically recalculate interest and principal payments based on the cash environment of any given month. Because debt creates interest, and interest impacts the cash used to pay down debt, the system must include logical circuit breakers to manage the resulting circular references. The balance sheet is not a passive reporting document. It acts as the ultimate lie detector, mathematically forcing your operational assumptions to face financial reality. The income statement records revenue and expenses over a period of time, but it ignores actual cash timing. The cash flow statement acts as the essential translation layer, stripping away accounting accruals to reveal pure cash reality. The integration begins by routing net income from the very bottom of the income statement to the top line of the cash flow statement. This establishes the starting point for operating cash generation. Simultaneously, that same net income travels a dual path, flowing directly into retained earnings within the equity section of the balance sheet, minus any dividends paid to shareholders. Non-cash expenses follow a strict three-step life cycle. Depreciation starts as an operational cost on the income statement. Since no actual cash left the business, it is added back on the cash flow statement. And finally, it is subtracted from property, plant, and equipment on the balance sheet. Executing these links requires absolute sign discipline. Across both the income and cash flow statements, cash inflows are always positive, and outflows are strictly negative. Linking to balance sheet assets requires a counterintuitive rule. Because spending cash on inventory or equipment is an outflow, it appears as a negative on the cash flow statement. To correctly represent that increase in the asset account, you must subtract the negative cash flow line item from the previous period's balance. Liabilities operate on the exact opposite logic. Taking on new debt brings cash into the business, appearing as a positive inflow. You add that positive cash flow statement line item to the previous balance to increase the liability. Failing to wire these operational nodes with perfect sign discipline guarantees your capital structure will break the moment you attempt to project debt. The operational model remains static until you introduce the debt schedule. This schedule continuously recalculates its own balances based on the cash the company generates, injecting extreme volatility into the forecast. Corporate capital structures are divided into specific tranches of debt, typically sized as multiples of the company's EBITDA. At the top sits the revolving credit facility, or revolver. Usually sized at 0.0 EBITDA at close, this acts as an undrawn corporate credit card, utilized strictly to cover emergency liquidity shortfalls. Below the revolver is senior debt. Often sized around 3.0 EBITDA, it features a floating interest rate tied to the broader market and requires strict mandatory principal amortization every year. Finally, subordinated debt sits lower in the structure. Sized near 1.0 EBITDA, this carries a higher fixed interest rate to compensate for increased risk and is usually structured as a single bullet repayment due at maturity. These varying risk profiles dictate a strict chronological order. By legal covenant, a company cannot pay a single dollar of principal to subordinated lenders until the senior debt obligations have been satisfied. A capital structure is a rigid hierarchy. It dictates exactly how operational success is distributed to lenders and precisely who takes the loss when cash dries up. A robust debt schedule utilizes a cash sweep. This is an optional mechanism where a company directs any excess cash left over operations to aggressively pay down outstanding debt ahead of schedule. The sweep algorithm starts by calculating total free cash flow before any financing activities or debt service have occurred. From that total, the model immediately deducts mandatory amortization. This is a contractual, legal requirement that must clear before the company can consider optional repayments. Once the mandatory payments clear, the algorithm hits a logical fork. It must assess the remaining cash balance to determine if the company is operating at a surplus or a deficit. If the cash balance is positive, the formula initiates the surplus path. It dictates sweeping a specific percentage of that excess cash directly toward optional senior debt paydown. If the remaining balance is negative, the deficit path takes over. The formula triggers an automatic draw on the revolver, injecting borrowed cash to fund the operational shortfall. To program this directional logic in Excel, modelers use specific combinations of min and max functions. This ensures the sweep repays exactly what is available without accidentally calculating negative debt balances when the loan is fully retired. A dynamic cash sweep algorithm transforms the model into an automated forecasting engine where debt balances react instantaneously to shifting operational performance. That reactivity creates the architectural paradox that routinely crashes advanced models, the circular reference. The loop begins on the income statement, where interest expense directly reduces net income. That reduced net income travels down to the cash flow statement, which inherently lowers the available free cash flow generated for the period. Lower free cash flow limits the amount of capital available for the cash sweep, keeping the end-of-period debt balances higher than they would be otherwise. Because interest is properly calculated on the average of the beginning and ending debt balances, that higher ending balance immediately recalculates the interest expense. The loop restarts instantly, forcing Excel into an infinite calculation cycle. The mandatory solution is programming a designated cell as a circuit breaker. This toggle switch momentarily forces the interest calculation to zero, breaking the logic loop and clearing the Excel cache to restore stability. Professional modeling certifications, such as the Level 1 AFM, test a candidate's ability to build and contain these circularities to ensure the reliability of a full integrated model. When you complete the linkages and the balance sheet check cell returns a massive, uneven number instead of zero, the pressure to force the math to match is immense. Resist the urge to use a plug. Inserting an arbitrary number to balance the sheet instantly destroys the mathematical integrity of the entire forecast, rendering your analysis useless. Systematic debugging starts with identifying common traps. The first is incomplete subtotals in the balance sheet that fail to capture newly added line items, such as deferred tax liabilities or prepaid expenses. The second diagnostic trap occurs in the debt schedule. Using the ending balance to calculate interest rather than the average balance for the period warps the cash flow outputs. The third trap lies in the translation layer. Failing to add back obscure, non-cash items from the income statement onto the cash flow statement will guarantee an imbalance. A rigorous audit workflow begins by isolating the error. You aggressively check the cash flow statement subtotals first, as this is where operational timing differences most often derail the math. Excel's Row Differences tool is the primary weapon here. It scans horizontal arrays and immediately highlights formulas that deviate from the established summing logic, exposing broken links. If the operations are clean, the secondary workflow is toggling the circuit breaker off. By killing the interest calculation, you can verify if the imbalance is buried deep within the debt circularity, or if it remains a foundational operational error. These imbalances are almost never conceptual accounting mistakes. They are symptomatic of sloppy structural workflow and poor Excel hygiene. Tracing an error back to its source, like a single dropped inventory subtotal, allows you to correct the logic. That single fix instantly cascades through the entire linked system. The visual confirmation is absolute. The balance sheet check cell drops from a jagged error value perfectly to zero. A professional model is engineered for auditability and resilience, ensuring the architecture remains intact even under extreme cash flow scenarios. The math holds together because the spreadsheet mirrors the actual physical flow of corporate capital. Every dollar generated, spent, or borrowed is perfectly accounted for. The three-statement model functions as a unified financial structure where every operational and financing assumption is bound by the same internal mathematical laws.